I recently made a huge £20,000 investment on a platform I don't even recommend. Now that probably seems completely backwards, and to be honest, it does feel a bit strange saying it out loud, but believe me that there is a very specific method to my madness. And if you stick with me, I'm going to show you exactly what I invested that money in, why I have such mixed feelings about trading 2 and 2, and most importantly, how you can avoid the single biggest trap on the platform that causes so many people to lose money. And just a quick reminder, this video is my honest opinion, and it's based on my own experiences. It's for educational purposes and is not financial advice. One final thing before we start is to say that I am not sponsored by any platform at all in this video, so you can definitely trust what I have to say. With that said, if you're looking for a simple, safe way to begin investing yourself, then you can check out my new Simple Start Investing Kit that's been linked in the description of this video. This is going to feel like a bit of a therapy session for me because I've had these thoughts for quite a while. It's tough because when a platform is this popular, you feel like you should love it. But the more I use it, the more I realize I might not be using the best environment for building the calm, confident, long-term mindset that I think is essential for success when investing. I know there are a lot of Trading 2 and 2 fans out there, so I guess we'll just see how this video goes down. Firstly, I'll address the question, how did I end up here and why put my single biggest investment to date on this specific platform? The truth is that Trading 2 and 2 is incredibly good at getting people through the door. For a while now, I've had a significant amount of cash sitting in their stocks and shares ISA. It wasn't invested in anything, just being held as cash because they were offering a competitive interest rate of 4.35% at the time, completely tax-free. That money was originally earmarked for the future with a dream of it becoming a deposit for a small house building project. But our plans changed when we realized that money wouldn't be needed for at least 5 years. So instead of letting it sit on the sidelines, it was time to put it to work for the long term. My entire investment philosophy is built on keeping things simple, and I was therefore looking for a single low-cost global fund that does 3 things perfectly. Number 1, it has to be globally diversified. I want to own a piece of thousands of companies worldwide to capture global growth. It must also be accumulating, and this means that any dividends are automatically reinvested for me, letting my money compound without me lifting a finger. And finally, it has to be low cost and also trade in pounds to avoid pointless fees. And I ended up finding an ETF on Trading 2 and 2 that actually ticked all of the boxes. The specific one is the SPDR MSCI ACWI UCITS ETF. It holds around 2,200 companies across the globe, has an ongoing cost of just 0.12%, and it's accumulating. It was the perfect, simple fit for my investment approach. Since I had already maxed out my £20,000 ISA allowance for the year just by holding that cash, I decided to go all in and invest the lot into this fund. For me, this is also a proper test run of the platform before I even think about moving the rest of my investments over into one place. Okay, so the investment itself is incredibly simple. But the platform, that's where it gets more complicated. And this brings me to why I'm so hesitant to recommend Trading 2 and 2 to somebody who is just starting their investment journey. I think it's because the platform feels like it's been designed for traders, not so much long-term investors. A trader treats the market like a full-time job, constantly buying and selling, trying to time the market. An investor, like me and probably you, wants to buy good assets and hold them for years, letting them grow over time. The whole environment on Trading 2 and 2 seems to encourage short-term thinking. When you open the app, you're often greeted with lists of hottest stocks or daily movers. This naturally draws your attention to what's volatile today, rather than what's a solid investment for the next 20 or so years. And then there are the emails. I've had a few from them that just rub me the wrong way. When I was just holding cash, I got one with the subject line, "Reminder, keep active and earn." It made me feel like I was doing something wrong. like I was on the clock. It makes you start to question yourself. Am I being too lazy? Am I missing out on something? Then, right after I deposited that £20,000, I got another automated email about good investment practices, saying they'd be looking for specific activity patterns that may pose financial risk. I know it's automated and meant to be helpful, but this creates this feeling of pressure, like Big Brother is watching. For a beginner who needs reassurance and simplicity, I think that kind of pressure is the last thing that you actually need. It can undermine your confidence and make you second guess your own long-term strategy. And that feeling of being pushed towards activity leads me to the most dangerous part of the platform, and the key to that shocking 77% of retail investors lose money statistic. If you look at the bottom of their emails or website, you'll see that warning. It specifically refers to something called CFDs, or contracts for difference. CFDs are not investing. They are a high-risk form of trading. Let me give you a quick analogy. Long-term investing is like buying a house to rent out. You own a real asset, you collect the rent payments over many years, and you hope the value of the house gradually increases over the decades. Trading CFDs is like making a bet with your neighbour on whether the price of that house will go up or down by tomorrow lunchtime. You don't own the house, you're just speculating on short-term price movements. And with CFDs, you can use leverage, which is like making that bet with borrowed money. It massively magnifies your potential gains, but it also massively magnifies your potential losses. And you can lose all of your money and sometimes even more than you started with. It's high-stakes gambling, not long-term wealth building. So how do you avoid this trap? The solution is actually incredibly simple. Just don't do it. Don't use it. On the app, you will see different sections. Stick to the Invest and ISA sections and never ever venture into the CFD section. That single decision will protect you from the biggest risk that exists on the platform. At the end of the day, the platform that you use is just a tool. The most important thing is that you start investing. That being said, some tools are definitely simpler to use than others, and my number one pick for beginners right now is Invest Engine. Think of it as the opposite of Trading 212. It's clean, simple, and focuses on one thing, which is exchange-traded funds or ETFs. There are no distractions, no individual stocks, and no interest on cash, and absolutely no CFDs. Its simplicity is, in my opinion, its greatest feature because it removes the temptation to fiddle. It's built for the long-term passive investing, which perfectly matches my own investment philosophy. And because that exact same ACWI ETF is available on Invest Engine, you can follow the exact same simple strategy as I am using, but on a platform that I feel is much more aligned with a beginner's calm, long-term mindset. Another great alternative is Dodl, which is owned by the massive UK investment company AJ Bell. The app feels friendly and less overwhelming. They have a more limited, curated list of funds and shares, but it's more than enough for most beginners. They do charge a small platform fee, but they also offer accounts that Trading 212 doesn't, like a lifetime ISA, LISA, for saving towards a first home or retirement, and also a SIP, which is a self-invested personal pension. To help you weigh up the pros and cons of these platforms and more, I've put together a free investment platform guide for you to download. Just check out the link for it in the description below. The more I think about it, the more I realize that how a platform makes you feel is a huge part of the decision. Does it make you feel confident and in control, or does it make you feel anxious and pressured? It's like buying a house. You walk into an open house and the estate agent tells you, everyone loves this place, it's the hottest property on the market. It has a huge garden, a flashy kitchen, 5 bedrooms, but maybe you hate gardening, you eat takeaways most nights, and you only need 2 bedrooms. That popular house isn't the right house for you, and you need to decide what you actually need rather than what's popular. So, should you use Trading 212? I'd say yes if you are confident that you know exactly what you want to invest in and you have all of the discipline to ignore all of the distracting features. And I'd also say yes if you want a powerful all-in-one platform for holding cash, funds, and individual stocks. But I'd say no if you're just starting out and you feel uncertain. The sheer number of options could easily lead to confusion and analysis paralysis, or worse, push you into making decisions that don't align with your long-term goals. Ultimately, picking a platform is just step one, and the most critical part is having the right investment strategy to begin with. A bad strategy on the best platform in the world would still lose you money. A good strategy, even on a basic platform, is what will build your wealth over time. If you want to understand the simple, boring strategy that I follow and learn how to avoid the common mistakes that cause 93% of investors to underperform, then you absolutely need to watch this video next. Thank you so much for watching. I hope that was helpful. Do drop any questions in the comments below and subscribe if you'd like to see more, and I'll see you in the next one.